Consider this sector ETFs when investing for growth. While the volatility of March now a distant memory, the stock market is testing new highs. That's because the economic slowdown caused by the global pandemic seems to be abating and previous job losses are being slowly recovered. Investors eager to explore growth opportunities once more may want to be a bit tactical than simply buying the broader stock market, however, and may want to focus on sectors that will benefit most from this growth trend. Here are 7 sector exchange-traded funds to consider as a part of this strategy. But before going further, let's refresh our memory on what is ETF. An ETF, exchange-traded fund, is an investment fund traded on stock exchanges, much like stocks. Most ETFs track an index, such as stock index or bond index. ETFs are attractive as investments because of their low cost, tax efficiency, and stock-like features. Hello there, this is Stockspert. I make videos about personal finance and investments. If you are interested in these topics, make sure to like the video and subscribe to my channel. Today we are reviewing the 7 best growth ETFs, and let's see what are they. For those who want to buy ETFs and stocks commission-free, you may want to check out eToro social trading platform by the link provided in the description and help this channel. The first one is Healthcare Select Sector SPDR. The ticker is XLV. Few things are certain in the US economy, but steadily rising healthcare costs one of them. A Kaiser Family Foundation report showed that when measuring in constant dollars, US health spending surged from $1.7 trillion in 1998 to $3.6 trillion in 2018, roughly doubling even when you exclude the influence of inflation. The XLV Healthcare ETF has become a gold standard for those investors who are looking for exposure to medical companies. It's the simplest way to play the constant green higher in healthcare spending with big-name companies like Johnson & Johnson, United Health Group, Pfizer, and AbbVie. This ETF boasts a 10-year average return of 16.6%, while the expense ratio is 0.13% and the dividend yield is 1.53%. Of course, some investors want to get a little more selective about the healthcare sector, given that entrenched giants like Johnson & Johnson may not have as much runway as smaller, up-and-coming firms. That's what the iShares biotechnology sector ETF offers, with the focus on a development stage drug makers instead of the more stable, blue-chip stocks that make up much of XLV. These include firms like gene therapy researcher Seattle Genetics and biotech Moderna. There's a bit more risk here, but it's offset by more upside potential. IBB also comes with a little bit higher expense ratio at 0.47% and showing 10-year return of 413% and dividend yield at 0.23%. Another sector that has a strong history of constant growth year in and year out is the technology sector. And with roughly $33 billion in assets under management, Vanguard Information Technology ETF, the ticker is VGT, is one of the most popular sector ETFs for investors looking to play this trend. The fund is heavily weighted in businesses that provide hardware, software, and data processing solutions. VGT holds big names in the sector that you probably know and love, like Apple and Microsoft, providing exposure to the tech companies in the world via single holding. To top it off, the fund gained whopping 48.7% last year for its annual total return, while the 10-year return is as much as 420%. And the expense ratio is 0.10% and the dividend yield is 1.07%. As with healthcare, however, some investors are more interested in playing with the true startups in the tech sector instead of the trillion-dollar mega corporations, which have already seen a lot of growth in prior years. This sector ETF from Invesco called Invesco S&P Small Cap Information Technology ETF. The ticker is PSCT, and it allows investors to focus only on smaller firms with an average market value of $1.6 billion per holding. And by the way, you may want to be interested in next FAANG stocks that we talked before. If you haven't seen this video, the link is in the description. PSCT includes PICs such as Annexter International, a communications hardware and cybersecurity firm you may not otherwise have exposure to in your core portfolio holdings. The 10-year total return of the ETF is 272%, while the expense ratio is 0.29% and the dividend yield is 0.15%. There's a well-worn factoid used by economists that profess 70% of the US economy is driven by consumer spending. But when you dig deeper, it's hard to claim that certain expenses like groceries will see significant growth or contraction from month to month. Discretionary spending, on the other hand, does have the potential to move up in a big way when conditions are good. And with the US economy recovering and opening, the time may be right to consider betting on spending growth. So the XLY is a sector ETF that gives you a footing in a wide array of stocks that can tap into this opportunity, such as Amazon, Home Depot, Nike, McDonald's, and Booking Holdings. A 10-year total return is 329%, and the expense ratio is the 0.13%, while the dividend yield is 1.13%. The next one is iShares US Financials ETF, IYF. When the economy is in growth mode, typically the financial sector benefits. That's because banks lend support to all manner of economic activity, from businesses that are expanding to consumers that are buying homes. This sector ETF from iShares offers investors a way to play some of the most influential stocks in this area, including payments giant such Visa and mega bank JP Morgan Chase, as well as famous Warren Buffett's Berkshire Hathaway. As businesses and consumers spend more, it's natural for the financial sector to broadly benefit as a result. The dividend yield is relatively high at 2.04% and growing each year, while 10-year total returns were about 116%, and the expense ratio is 0.42%. And to supercharge your investments in the growth of financial sector, investors can simply focus on smaller and regional banks that offer a more direct play to community lending. After all, the big banks have sprawling global operations that sometimes veer into sophisticated institutional products, while the components of the next ETF, KRE, tend to be simply in the business of extending loans in the community. These include companies such as People's United Financial, a financial firm that have 450 branches, mostly located in New England. Banks like this are much more focused on small business and consumer lending, and thus they may be a more direct play in this growth trend, even if regional banks have less capital and come with a bit more risk as a result. The expense ratio of this ETF is 0.35%, and the dividend yield is pretty high at 3.61%, while the 10-year total returns were about 64%. Warren Buffett recommends ETFs to most investors, and for good reason. As one of the greatest investors of all time, Buffett knows a thing or two about investing, and being a stock market investor made him a multi-billionaire. Why not learn from the best? If you have the long time horizon and don't want to spend very much time on investing in the stock market, ETFs could be the best choice for you. Historical performance is not a guarantee, nor an indication of the future. And before making any investments, you should always make a research or consult that all your investments are in line with your investment and risk profile. And as Warren Buffett points out, just make sure to own a piece of the market. If it was interesting and useful for you, please like the video and subscribe to my channel. Thanks for watching and see you next time.